All right, welcome to this month's market update for Los Angeles County. This includes all of the general areas of Los Angeles County, including Long Beach. Take a very broad look at the overview, and then we jump down into some of the different sectors and talk about the different housing numbers there. That said, I wanted to first wish everyone a Merry Christmas, a Happy Holidays, and a Happy Hanukkah as well, as we are in Hanukkah currently. I hope that you're enjoying time with family during these unusual circumstances and times, and just really enjoying the company of loved ones. That said, let's jump into it. I'm only going to talk about the economy briefly on this episode. There's not much else to say other than the fact that we are seeing a spike in COVID cases. We have been put into lockdowns. This is going to affect where people go and how they're making decisions right now. And we're going to talk about some of that in this episode as far as it refers to housing and the decisions that people are making. However, I am going to talk about unemployment briefly. All right, quick quote for us before we get started here. Even with the signs of a recent slowdown, the labor market recovery since the spring has been stronger than most economists expected. Many now project widespread vaccine distribution will eventually help lift the economy further as businesses are allowed to reopen and consumers feel more comfortable traveling and going to the movies. This is from the Wall Street Journal, Jeff Sparshott. Looking at the BLS numbers, now this is the Los Angeles numbers really quickly. Remember that the local area numbers trail the national numbers by 30 days while they take in corrections and make adjustments and whatnot. But right now we are moving in the right direction as far as LA is concerned. LA in general is a hospitality and services industry oriented town as far as its businesses, and that is the vast majority of what is currently unemployed. When we look at the national unemployment numbers, though, we are doing very well. We're still holding. We're at 6.7%. This is a good sign, and let's all hope that this trend continues as we try to get back to some kind of normalized employment when it comes to some of the other sectors opening up. Okay, foreclosures and forbearances. Now, we have been talking about this for a while now. I have many people that I speak to regularly who are expecting massive price declines in the marketplace. That is just not the case at this moment in time. We're not seeing it. And I'm going to go into some quick numbers just to kind of go through it really quickly. This first slide really talks about the number of active mortgages in forbearance, and it's been decreasing rapidly since the beginning of this crisis, since this chart reads since May. So how do we get from 4.76 down to 2.79% million homes in forbearance? That is not a lot of homes when you look at the national average. The number of homes that were in foreclosure during the Great Recession was substantially more. But when we look at how everything is shaking out, we now have some of the stats and data that we can look at that says, here's what happened. So 54% paid in full. Now that means they already caught up all their payments, they paid off their loan in full, or made their monthly payments during their forbearance period, which pulled them off of when they got off the forbearance list. 23 to 24% did a loan deferral, while 6.8% did a modification. Another 12.8% no loss mitigation plan. And the final last amount is 2% on repayment plans, short sales, or deed in lieu's. So this is not going to spell a foreclosure crisis. We're not going to see massive waves of foreclosures flooding the market. Sorry to the naysayers. Any foreclosure increases will likely be absorbed by the market. It will not lead to any price declines. This is the chief economist from National Association of Realtors, Lawrence Yun. This is holding true. We're not really going to see any kind of massive declines in the marketplace with foreclosures. We're just not in the same circumstances as we were in, 2008, 9, 10, 11, 12. Just different market, different times, different circumstances altogether. So when we look at the housing market in general as this update, We're kind of looking at this housing recovery index. This is put out by Realtor.com, in which they base it based on certain factors, those being demand, supply, time on market, and price. Basically, they look at this and they go, okay, here's where the market was, here's where it is based on these factors, and they came out with some kind of logarithmic algorithm in order to figure out how to calculate this. For the most part, this chart demonstrates one very thing that we know is true, that single-family housing is selling very strong, and the housing market is very healthy and strong at this moment in time. That's all we need to really pull from this. That said, buyers and sellers quickly jumped back into the market this week after taking a break during the election week, according to Realtor.com's weekly housing report for the week ending November 14th. We did see a pause in activity in the week leading up to the election and the actual election and a little bit thereafter, but buyers have been getting back active in the market again. They are out in the marketplace looking for different houses and putting in offers again. But are prices going up too fast? It's a great question. Are prices rising too fast? Well, according to Craig Lazara, housing prices were notably, and I'm tempted to say very strong in September. The National Composite Index, NCI, gained 7% relative to its level a year ago. Our 3 monthly readings since June of this year have all shown accelerating growth in home prices, and September's results are quite strong. So again, the housing market is very strong. So are housing prices rising too fast? Well, when we look at compound home annual appreciation rate since 1991, that averages out to be about 3.81%. When you look at since 2012, it's 6.1%. Well, why? Well, partly because we started at a lower place and it was easier to go higher faster, all right? I think that's one reasonable assumption as far as growth. But when you map this out over time, you can see that the 3.8% historical appreciation rate, and this is the national, not Los Angeles, so if you think I'm sitting here talking about LA right now, you're not paying attention in the home game. The national appreciation rate, when you look at it, going from roughly $140,000 up to somewhere just under $300,000 for a single-family house. What does that say? Well, when you lay that in with what the actual numbers are, you do get a sense of where appreciation has been. You know, we saw some spikes in appreciation in the early 2000s because of the way that the market rose up, and then it pulled back down tremendously. And then it rose back up and it kind of met that line, and then now we're in a moment in which we've seen a little bit of a spike. Well, does this mean impending doom? Well, no. And part of the reason it does not mean impending doom is because we're talking about different types of financing, different types of qualifications to get a mortgage. Most people are getting a 30-year mortgage. They're not getting an adjustable rate mortgage, and they're not being approved for a loan based on stated income factors. They're being approved solidly with solid down payments and solid metrics. Qualifications used to approve those loans. So totally different circumstance. Now, the media will probably take it, and I think I saw one headline from, we won't say who, over $1 trillion in mortgage debt. Here, hit the hit the Shan button. No. Crazy people. Why are home prices appreciating so much? Well, basically because we've seen dwindling supply. And under COVID, we saw it go to an extreme level. We did see it start to peak up a little bit, but under COVID, it fell off. Everybody wanted a house, and the ones who could get one got one, and everyone else, it just kind of trickled down. Why? Because single-family houses just became in vogue, and people just went after them in droves. That kind of drove home prices up to new highs. Now, mortgage balances, the largest component of household debt, rose by $85 billion in the third quarter and sat at $9.86 trillion on September 30th. Mortgage originations, which include refinances, were at $1.05 trillion, the second highest volume in history of series and second only to the historic refinance boom of 2003 Q3. So again, when we talk about what people are doing with their homes, they're actually paying them off. And I don't have that slide handy right now, but it has been evident that when you look at almost 60% of homes own 90% or more equity in their homes, they're paying them off. And the ones who are refinancing for whatever reason that they need. But we're not seeing a massive pullout of equity and using it as a credit card like we did in 2003 to 2007, 2008. It didn't happen. That said, when we look at how much consumers are actually spending, this is household debt service ratio. So what you do is you take the total required quarterly mortgage payments and divide that by quarterly disposable income, and you get a percentage. It's a qualification metric that is used for mortgages as well. But basically, it states that we're still fairly low, especially when we look at the housing bubble of 2007. Remember how I talked about how people were refinancing their homes and using them like credit cards? Well, that is evident in the 7.21% debt service ratio that happened during the mortgage credit crisis. So we're not in that same scenario today. Mortgage rates, they're still going to stay low, and we're seeing that. The projection for mortgage rates through 2021 in order to sustain this recovery and make sure that the market stays liquid is going to stay at about where it is at 3%. Might see a little bit up, might see a little bit down, but it's going to stay on average probably about 3%, and that's pretty consistent and projected, and that's what they're looking to accomplish over the next year. Home prices are still ranging between 6 to 2%. I know I said that backwards. 2 to 6%. Is that better? Overall, everyone agrees that as things open up and loosen up, things will continue to be shuffling around a little bit and will stay pretty strong into the next year. All right, single-family active listings in the marketplace is currently 8,919. That's a 24% decrease year over year. As will be demonstrated in another slide later, this is a decade low. This is the lowest inventory we've seen in beyond 10 years. My chart that I'm going to show you goes back to 2009, and this is the lowest point ever. The number of single-family pending sales has fallen off as well. Not currently expecting too much a rise. That's about a 15% decrease in sales for this past month. The number of closed sales still stays pretty strong. I think people are chilling for the end of the year is what's going on. That is 11% increase year over year. As far as the number of active listings versus closed sales, this is one of my favorite charts. The point of this chart is simply to demonstrate the number of active listings in the market versus the number of closed sales. Closed sales has stayed fairly consistent. Active listings, however, is at its low, which means something has to happen. When we look at home prices, you can see that we did see a spike this year in the median sales price for a home in California. This is partly due to, which I will demonstrate later, to the $1 million and below category in which people, first-time buyers and new home buyers, are going out into the market and buying at a lower price point than the million plus. We will go into this further. But for now, know that it is a 17% increase year over year in the city of Los Angeles. If you're thinking of selling, perfect time to sell. Single family average price per square foot, $549 per square foot. We did see it rise up during the past 6 months. We have seen it pull back just slightly, but it's still up 12.3% year over year. As we look at the average price per square foot by price range, this is a chart that I started doing recently. This covers, basically, when you look at the bottom row, that is the $1 million or less home. The next row up is $1 million to $2 million. The row up above that is $2 to $5 million, and then above that is luxury at $5 million and above. Now, most people consider $2 million and above luxury, but in LA, we have different categories. So you can see that over time, the entry-level housing, or the $1 million or under, has been rising pretty consistently and has had a nice, healthy spike. The $1 to $2 million has risen also over time, but it goes through ups and downs. It's a little bit more volatile than the entry-level housing. And the one up above that, $2 to $5 million, is a little bit of wonkiness going on there as well. And then you look at the luxury market, and that is pretty much whatever somebody wants to pay for, what it is that they see, they're going to pay for it. Single family month supply, this is also at a low, 2.4 months. That is a 20% decrease year over year. As I mentioned, this is a decade low. Now, as you can see on this chart, we are seeing that the shadow inventory, that is the number of expireds, withdrawals, and canceled out in the market, was pretty substantial. In fact, we saw it double what it normally is at this on every single month, which means that there's a lot of inventory out there that's not even on the market. You can see since 2010, this is the lowest amount of inventory that we have seen ever, at least in the past 10 years. And that's important because that's driving pricing. Now, when we look at the amount of active sales on the market, along with the closed sales on the market, you can see that the number of closed sales is staying at the top end of its range. The number of active listings has fallen off to its extreme low, and the average price per square foot has risen dramatically over the past 6 months. This is because of the lack of inventory. Condo active listings are at 3,223. That's a 17% increase year over year. We did see a little bit of pullback on the number of active listings, but it seems to be holding pretty strong. The number of pending listings, as we're going into the end of last month, has fallen off pretty dramatically. We saw this in single family houses as well, largely probably due to the elections. That is a 22% decrease year over year. That said, we also have the closed sales, which is still above what it was a year ago, a 26% increase, over 1,000 sold. That is a good sign. It means that people are still engaged and buying condos and actively looking at them. The median sales price did pull back some to $514,000. That's still a 6% increase year over year. And the average price per square foot rose slightly to $522. That is a 4% increase year over year. When we look at the average condo price range, all of the lower tiers, that's anything under $1 million, did pull back. It pulled back pretty consistently. We'll see if this trend holds. We're watching it to see what happens, but you never know. As far as the month's supply, 3.8 months. There's probably a shadow inventory out there of condos that could not sell in the marketplace right now. That is a 22% decrease year over year. All right, last but not least, this is one of my fun little charts that I've been kind of starting up and watching. I wanted to see how the rentals were being impacted in the market as COVID was taking its hold and people were making decisions as to what they were going to do, especially with all the shutdowns. So in this case, I've been using apartments.com as a metric. Why apartments.com? Well, because they aggregate a lot of stuff and put it into one roof. And we are seeing an increase in rentals. We saw it when it was at its low point at about 37,000 rentals available, in August. Now it has increased to 41,187. That is a large supply. This does not include Santa Monica, Culver City, Beverly Hills, West Hollywood, all of the own incorporated communities that are out there. This is only the city of Los Angeles and does include Long Beach as well. That said, that's it for this month. I hope that you enjoy it. I hope that you have a fantastic holidays. Happy holidays, Merry Christmas, and Happy New Year, Happy Hanukkah. Whatever you're celebrating, I hope that you do it safely and with loved ones. Take care.